If you are specifically looking for double candlestick patterns in the context of Forex trading, there are various patterns that traders often analyze for potential trend reversals or continuations. Here are a couple of double candlestick patterns commonly used in Forex trading. Tweezer tops. This pattern consists of two candlesticks with almost equal highs. The first candlestick is bullish and the second is bearish, indicating a potential reversal from an uptrend to a downtrend. Tweezer bottoms. This is the opposite of tweezer tops. It consists of two candlesticks with almost equal lows. The first candlestick is bearish and the second is bullish, signaling a potential reversal from a downtrend to an uptrend. Bullish and bearish engulfing. As mentioned earlier, the engulfing pattern involves two candlesticks. In a bullish engulfing pattern, the second, bullish candle completely engulfs the body of the first, bearish candle, suggesting a potential reversal to the upside. In a bearish engulfing pattern, the second, bearish candle, engulfs the first, bullish candle, indicating a potential reversal to the downside. Dark cloud cover and piercing line. Dark cloud cover. This is a bearish reversal pattern. It consists of two candlesticks where the first is bullish and the second is bearish. The bearish candle opens above the close of the bullish candle but closes below the midpoint of the bullish candle, suggesting a potential reversal to the downside. Piercing line. This is the bullish counterpart to the dark cloud cover. It consists of a bearish candle followed by a bullish candle that opens below the close of the bearish candle but closes above the midpoint of the bearish candle, indicating a potential reversal to the upside. Remember, while these patterns can provide valuable insights, they are not foolproof, and it's essential to consider them in the context of the overall market conditions and use them in conjunction with other technical and fundamental analysis tools for more robust decision-making in Forex trading.